Hello, this is Robert. I'm a tax attorney here at TRP, and we're going to go over income averaging for offering compromise, what it is, and using it to your advantage. Now, this subject seems to get missed in a lot of consultations where people are talking to tax relief salespeople. They don't seem to cover this subject, and especially for self employed people, this comes up quite a bit. And you can get more information about us at trp.tax, or you can contact us at 888-515-4TAX. That's 888-515-4829. So varying expenses. If you got an upcoming child, you're moving, job's making you move, something like that, if the necessary expenses are going to change in the future, the agent should calculate those in your ability to pay. So they know you're going to move. The offer and compromise people should be adjusting the numbers to those move numbers. And if they're higher, that's going to work to your advantage. Varying income. This is really common for self-employment people. The common thing to do is go over the average earnings over the prior 3 years. And if they're not using the prior 3 years, then there should be a good reason. Now, COVID for some people, maybe it just completely decimated their business. Now, maybe they might be able to get around some of that prior 3-year averaging. But if it looks like after COVID, things are just going to come right back to normal, then good chance the agent's going to go with the prior 3 years. Seasonal unemployment, the yearly average. So when you're consistently laid off and reemployed each year, they might use your prior year's income or income averaging to come up with an average monthly income. So people that are seasonal construction workers, there's some oil field workers that are seasonal. They're going to use the yearly average unless it looks like it's just not going to happen again. And this was really the last time you were working there, the most recent time. Underemployed. So anticipated income might get used. You work less during some periods of the year, or you currently work less, but are expected to work more in the future. And here's an example. You got a teacher working less in the summer while not receiving any payments from their main job during the year. So they got a teaching job during the year, pays them so much. Now they're not getting it. They're working in the summer and they're getting less money. Some teachers do have their pay set where it evens out over the year, but if they don't, that's considered underemployed during the summer. If there's an apparent chance for employment, the examiner will use what you would make at full employment. They consider special circumstances and are really looking for regularity to attribute the higher regular income to you. So they want to go with what's regular, not what is just right now. And if it ends up being every year you're underemployed, they'll come up with a yearly average for that. Long-term unemployed people. Sometimes that's a free ticket to an offer and compromise. If there's a verified expectation the taxpayer will be securing employment, then the use of anticipated future income may be appropriate. Use anticipated future income in situations where the future employment is uncertain. That's taken directly from the Internal Revenue Manual. That was the easiest way to explain it. And other than that, if you're just long-term unemployed, got no assets, offer and compromise might be pretty easy. There's also some ways to sometimes get around certain assets, but we're not covering that here in this guide. Long-term underemployed. Your income gets treated as it is. So there's no future opportunities, then the examiner will use the current numbers as is. If you otherwise meet OIC requirements due to not enough income and low assets, you should have a simple case and acceptance. And OIC obviously meaning offer and compromise. But a lot of people that are underemployed, when it's just regular, it's easy. Their case ends up being really simple. And you should see our offer and compromise guide for more info, and we'll have those links below. Poor health. Reducing the future. If you're in poor health and not working much longer, that should be taken into consideration. Numbers will be adjusted to reflect the likely decrease in the future. So if it looks like you're going to die in the next couple of years, or it looks like you're just going to be debilitated where you're not working and you're only going to be receiving possibly unemployment or disability, something like that, they're going to take that and adjust the numbers accordingly. Retiring soon. Adjusted to change as well. If you're retiring soon, the IRS will adjust down future income. Another thing with offer and compromise to consider is you might not want to take your Social Security yet because it might make it so you don't qualify. So factor that in. If you're not sure and it's too confusing, give us a call. Overtime. Is it regular or temporary? IRS uses base pay if it's temporary. If it's ongoing and regular, they calculate the overtime into your regular monthly income. You are not forced legally in any way to work overtime. If you stopped working overtime and decided that you didn't want to do that anymore, then your numbers would be based on what it has now become. They're not going to hold you to a lifetime of overtime. But if you just keep working it and they're reviewing your offer and it still shows overtime, overtime is what they're going to use. So in some cases, you may find that the overtime is the amount that is the available income. And so you really theoretically are almost just working to pay the IRS. And it's up to you if you want to continue to do that or not. Bankruptcy, value of future income adjusted. The IRS might reduce the value of your future income, but they don't discount it more than they would get out of payments from the bankruptcy, if any. So Chapter 13s are the most common type where you're going to be getting a payment submitted and paying it off over, I think it's 5 years. I'm not a bankruptcy expert, but I believe it's 5 years of payments for Chapter 13. And you know what? If you have a lot of debts, a lot of other debts, plus old tax debts, bankruptcy might be better. A lot of people won't tell you that. A lot of tax attorneys won't tell you that because, quite frankly, bankruptcy is an easier procedure and often cheaper than doing tax relief. But it will just fix everything for you a lot of the time when you got a lot of debts. Sometimes you need OIC and bankruptcy when you have newer tax debts. So they got to be on record for a little while. I believe it's 2 years, and there's a certain amount of days for audits. And ask your bankruptcy attorney to say, hey, are these dischargeable or they're not? So if you're going through a bankruptcy, you might be discharging, like, for example, today is 2020. Maybe you're able to discharge 2014 and 2015, but you also owed on 2019 and you owed on 2018, and you're not able to discharge those. So you do a bankruptcy, get the first two off, and then do an offer and compromise on the other two. When taxes are your primary debt, though, usually bankruptcy is not the best option because you'll typically qualify for an offer and compromise, and it's better on your credit, and we can get the liens withdrawn most of the time. So get help from expert tax attorneys. You can call us at 888-515-4829. That's also 888-515-4TAX. Or go to our website at trp.tax or click the link below. We order the information, check it all out, file what needs to be filed, and proceed on the best resolution. If we cannot help you, we'll tell you. There's no false promises for settlements. We only submit settlements when appropriate. Thanks for watching. Have a great week.